associates. I'm telling you, this kind of a student who knows that we don't consolidate associates, that's a student that I should be able to reward. That's a bright student. We don't consolidate associate. As per IFRS 10, consolidation shall only be done between financial statements of the parent and the subsidiaries. You take the financial statements of the parent plus the financial statements of the subsidiaries. You don't add the financial statements of associates line by line. Whenever you are doing group accounts, you don't do that. So those are good, bright students. So they have told us here, which is very important, ladies and gentlemen, is this fact here. This fact here, which is very important. Remember, we have just bought 80% of Handy. So Handy is a subsidiary, and the 40% of Comic. So Comic is an associate. And as somebody has told us, if it's a KASNEB question paper, I will delete this column of Comic, the whole of it, because Comic is an associate. Comic will never be consolidated. So, ladies and gentlemen, what do they want me to do? If you look at the question down here, they want me to prepare a consolidated statement of financial position for Laurel and its subsidiary. They're very categorical. And its subsidiary as at 31st December 2019, incorporating an associate in accordance with IAS 28, where IAS 28 basically tells us to use the equity accounting method for associates. You calculate the equity of the associate, get the total, like what I'll call value of the associate at the end of the year, at the end of the financial reporting period, as one figure. That one figure is what you take to the balance sheet and call it investment in associate. Otherwise, the line by line consolidation is only done for what year? Is only done for a group of companies, and a group of companies we're looking at the parent and who? The subsidiary alone. So then what I will do, ladies and gentlemen, Sheila is asking a very good question there. So what I'll do, ladies and gentlemen, here, it's page number 44, Sheila. So what I'll do, I will come and copy this. This is how I start doing this question. I'll come and write there the name of the parent. The parent is called Laurel. The parent is called Laurel. So we have here Laurel Group. Consolidated statement of financial position. Or financial position as at. I'm so sure that one is something that all of us are very good at. Ladies and gentlemen, I'll simply start copying this table the way it is. So I'll start by writing there non-current assets. So I have here non-current assets. So non-current assets, what do we have there? We have two of them. We have property, plant, and equipment. I'm adding line by line. So I will take, in this case here for Laurel, it is 220. So I will take 220 plus 160. 220 plus 160. 220 plus 160. 220 plus 160. Could you kindly give me this answer? Because now I'm consolidating, I'm adding. And remember, we can't bring the PPE of the associate. We don't consolidate associates. So can somebody give me this answer? What is 220 plus 160? What is 220 plus 160? What is 220 plus 160? Can somebody give me the answer? You are so wrong, Tabby. Tabby, that is so bad of you. Anybody who is giving me an answer of 380, if it was during those days when there was corporal punishment, I would have beaten you so seriously. Because remember, the first step of consolidation, you don't just start adding figures. We are not yet there. Here we are basically laying down the pro forma. Later on, we shall be making adjustments. Like if there are any revaluations, we shall be making adjustments. So basically, we are putting down a pro forma where we are taking the figure of the parent plus the figure of what is the subsidiary at the end. Of course, should I reach that time, ladies and gentlemen, where time runs out, I don't have enough time now to continue with my adjustments. What do? I'll do what Tabi has told me. Add them up. And then at the end of the day, out of 10 marks, I'm assured of getting a minimum of 4. That's how you harvest low-hanging fruits. So as I continue, what have we learned really? The thing that I've learned here as we continue is that we shall never be consolidating figures of associate. We shall not bring figures of associate here, but you can't say 220 plus 160 plus the associate figure. No, that we can't do. We are only consolidating the parent and the subsidiary. We're only consolidating the parent and the subsidiary. Now, one good thing here, for students, of course, who are privileged to be having computers, I expect you guys to be writing all these in your Excel, isn't it? Excel. That's how we want now to start training our students. You write all this in Excel, right? PPE in Excel. Thank you so much, in Excel. Now, ladies and gentlemen, please, we continue. Let's go to the next thing. So the next thing, they're calling it investments. Whenever you see investments now, you must break this investment in 2. We must break investments into 2. The first investment will be investment in the subsidiary. Investment in subsidiary. And then we have what we call investment. We have only 2 investments in associate. Investment in associate. And then remember, ladies and gentlemen, there is no way you can keep investment in a subsidiary in group accounts, because a subsidiary is yourself. A subsidiary is your better half. A subsidiary is your spouse. That's how serious the relationship is. And this is where we go wrong even in marriages. That, for example, if I pay for my wife a master's degree, maybe I've paid 500,000, that as a husband, I should never be, in this case here, booking that as an investment. I mean, that is as good as having paid that fees for myself. Because keeping that in your books every time you're reminding this woman, you're telling this lady every time that, you know what, I took you to school, that will bring issues, because you're supposed to be one thing. So, ladies and gentlemen, remember, if it's an investment in your subsidiary, the only thing you can enjoy are the fruits. You took this wife of yours to college, she's been able to get a master's degree, and perhaps she's gotten some promotion there. So investment in subsidiary will always be struck off and substituted by what we call a goodwill. So this one, we shall always strike it off anywhere you see it. And then you compute what we call goodwill, because now utakuwa nakula matunda, goodwill like that. But investment in an associate, we shall leave this one always here. Investment in associate, that I shall always leave it there. So are we together, ladies and gentlemen, that we shall never be having investment in subsidiaries in our group accounts? Instead of investment in subsidiaries, we shall be having what here in their place? Goodwill. When I pump in my subsidiary, I keep on investing in my subsidiary, I'll be enjoying goodwill. I'll be enjoying goodwill. Nimatunda too, I like that. Ngosi, I like that. So I hope you've been able to rub yours like that. So, but we shall leave here investment in associate. We shall be doing this later in accordance to IAS 28 principles. Great. So we are continuing nicely. So go to the next step. Next step. We have here current assets. So current assets. So we have here current assets. Current assets. Current assets, what do we have? We have inventory. We have inventory. We have inventory. We have inventory. Stop video. We have inventory. So inventory, I'm consolidating, remember? So I'm taking 384 for Laurel, who is the parent, isn't it? 384 for Laurel, who is the parent, plus Hadi, 234. Plus Hadi, 234. Why am I not saying plus 122? Somebody who is following. Why am I not saying plus 122? Why am I not saying plus 122 for comic? for comic. Why am I not saying plus 122 for comic? It's an associate and we are not allowed to consolidate associate figures. It's an associate, thank you very much. So we live like that and we are not picking anybody's calculator. Thank you so much. Great, you guys are really following. You guys are bright people. Now, so we go here to the next item. It's called trade receivables. So receivables. So we have here receivable. So receivables, I can see a figure over 275 and 166, 275, and then we have 166, and then we have cash at bank. So we have here cash at bank. So cash at bank, 42 and 10. 42 plus 10. So that I'll be able to have total assets there. And then I'll come and pick equity. I'll come and pick equity, of which I will start with the ordinary share capital. Ordinary share capital. This one is normally a free mark. So ordinary share capital, what do you know about ordinary share capital for group consolidations accounts? What do you know about ordinary share capital? Anybody who has an idea about ordinary share capital? That I shall always pick the parent only figure, yes, parent only. So you take this to the corner here, where now you have, in this case, your shillings or your dollars here. So in this case here, ordinary share capital, parent only. Parent only. The same case with share premium, isn't it? The same case with share premium. These are free marks normally. Share premium, it is parent only. It's parent only. It's parent only. It's parent only. All right. So, ladies and gentlemen, in this case here, what do we have? For ordinary share capital, the parent figure only 400, and then share premium 400, 400, and then share premium, ladies and gentlemen, we have a figure of what they are, 16. And then we have retained earnings. Retained earnings. This one I will need a working, an independent working, and I'll be able to show you a shortcut for this, for retained earnings. Now, ladies and gentlemen, remember, when I'm doing group consolidations, in terms of equity, we shall always give birth to a new kid. There is a new kid who will be born here. Is there somebody who can tell us, in this case, the name of this new kid under equity? Under equity, there is a new kid. There is a new kid who comes here normally. I don't know whether it's a baby girl or a baby boy. Thank you very much. It's non-controlling interest, NCI. It's a new kid. You write here, NCI. You write here, NCI. Please write in full. Non-controlling what here? Non-controlling interests. S tells us it has to be a baby girl. It has to be a baby girl. So NCI, we shall do a working for this. I may not even get time to do the working, but it's important to demonstrate broad and deep understanding of the subject. By just writing the name here, somebody may have some sympathies. I mean, it's about scaring. You can even scare this examiner just by putting some of these things there. So after equities, then we go to the liability section. Now, liability section, we normally start with non-current liabilities. So we normally start with non-current. You are following this. So we have, in this case, do we have any non-current liabilities? No non-current liabilities. So we have only current liabilities, of which we have the trade payables. So we have the trade payables. We have the trade payables. So under the trade payables, what do we have here? We have 457 plus 343, like that. So that is it. Then now we think about any adjustments that are needed. So we start now straight away. Before you compute Goodwill or whatever, just go to the notes here to the accounts. So we start number one. On 30th November 2019, Laurel sold some goods to Hadi for cash for 32 million. These goods had originally cost 20. So they've given us cost, they've given us sales revenue. They've given us cost, they've given us sales revenue. So whenever I see cost of goods and I'm seeing revenue, then I should be able to compute profit. Who knows the formula of profit in this case? Whenever I see cost and revenue, to get profit, I will take revenue minus the cost. So for these goods, in this case that were sold internally, the fake goods, fake sales sold internally, I sold these goods in this case here for 22 and they had cost for 32, and that cost me 22. So what is the profit there, somebody? What is the profit there, somebody? Somebody is following. Because I'm seeing cost and I'm seeing revenue. I'm seeing a profit of 10. A profit of 10. Thank you very much. So if these goods were sold, all of them, then I will be able to realize the profit as a group. If in this case here, all of them were still within the group, then the unrealized profit here will be that 10. If 50% are remaining in the group, then I will only recognize 50% of the total profit, internal profit, as unrealized profit. So remember here, the examiner wanted to run away from this concept students are always used to, the one of computing UPS, unrealized profit, using the profit margin approach. He never gave us any profit margin. No profit margin was given. No profit margin was given. No profit margin was given. So in this case here, what he did, ladies and gentlemen, was to give us, he told us on 30th November 2019, Laurel and sold some goods to Handy for cash, internal revenue, internal sales. Handy, or rather Hardy and Laurel, these are parent and, I mean, you are supposed to parent your kid 100%. Don't sell goods to them. Even when, for example, you are too old, don't sell assets to them. If you sell to them, you are just getting money from yourself. That's fake sale. So fake sales must be canceled. But now remember here, we are not doing an income statement. So in the balance sheet, what basically I'm interested in is unrealized profit on this stock. These goods had originally cost 22 million and none had been sold by the year end. None had been sold by the year end. So can somebody in this case here give me the UPS? UPS. None had been sold. UPS. So remember, profit generally, to get profit generally, we take revenue minus cost. So revenue is 32 million minus 22, which gives me 10. And all this profit is well within the group. And unfortunately, this is in inventory because we moved these goods from one company to another sister company, inventory. So basically, inventory is overstated. Inventory is overstated. So then somebody tell me, what should I do to this inventory working here? Should I come and say plus 10? IS2 tells us that whenever you smell, even if it's a little bit, whenever you smell profit in inventory, go and deduct less 10 from inventory, minus 10. Imagine there will be no any other working here. There'll be no any other working. I normally get students failing in advanced financial reporting, especially where we have this kind of questions, and I even laugh at them. I mean, what is really here to fail? What is really here that you cannot understand? It's a straightforward thing. Why should I less 22 million? In the balance sheet, we cannot less 22 million. In the balance sheet, I'm only interested in the UPS and realized profit. And once I've realized that this is the profit that one of the companies, ladies and gentlemen, in this case here, claims to have made. One of the companies claims to have made a fake profit from a sister company, which is 10. So that is what we call UPS because they are not sold anything of this. So UPS is 10. So go here and subtract what they are, subtract that 10. So are we together, first of all, up to here? Up to here, are we together up to here? Great. Great. They're not typing very fast. Great. Thank you so much. Great. Great. Dego is saying that they sold half. Perhaps we are reading different books. Let me see. Perhaps they're reading different books. If they sold half, then we shall only recognize a half as unrealized. Let's see. You see this, there is a full stop here. On the same date, Laurel also sold goods to Comic. Who is Comic? Comic is an associate. I will not even read this sentence to the end. Because anything we do with this associate will have one adjustment when I'll be computing what we call investment in associate. All right. Right now I'm consolidating, and the consolidation really is all about the parent and the subsidiary. So this, for now, is just noise. On the same date, Laurel also sold goods to Comic for cash for 22 million. These goods originally cost 10 million, and the Comic had sold a half of the, I think this is where you're confusing. Half is for Comic. That's for associate. Now we are not doing anything for the associate in group consolidations. IFRS 10 tells us to consolidate only the parent and the subsidiary. For now, we're not touching associate at all. And even myself in an exam, chances are I'll not even do the investment in us. I'll not have that time. I just consolidate alone, do the consolidation. So now I hope we are together up to there, all of us. I hope all of us are together up to there. Great. So then we take on the next thing, note 2. On 1st January 2017, Hardy owned some items of equipment with a book value of 45 million that had a fair value of 57 million. Remember, 1st of January 2017 is when we were acquiring our subsidiary. We acquired the subsidiary on 1st January 2017. So on this acquisition date, ladies and gentlemen, we had an item of plant whose carrying amount was 45 million. Carrying amount was 45 million. And then the fair value is 57. So then you as an accountant, when you go and realize this is the carrying amount, 45, fair value is 57 on the date of acquisition, what should you do? What should you do? What should you do? Carrying amount is 45, and this item fair value is 57. You revalue. It's a revaluation. We revalue. And this will be a revaluation upward, because what we have said is that whenever the fair value is at the roof, whenever fair value is bigger, then that is a revaluation upward. So then, ladies and gentlemen, could you kindly give me this revalued amount? Yes, or fair value adjustment? Yes. So what is a revalued amount? Is there somebody who can give me the revaluation? The revaluation, and this is up. It will be 57 minus 45, which gives me how much? 12. So then if it is a revaluation upward, we know that our assets, of course, are understated. We need to come and behave. So we need to come and capture this like a new value. So in the PPE, you say plus what here, somebody? Plus 12. In the PPE, you say plus 12. You increase the PPE by the revalued amount. If, for example, the fair value was less, if the fair value was less than the carrying amount, it would have been a revaluation downward. And if it's revaluation downward, what do? You subtract. If it was 12, I would have said minus 12, minus 12, minus 12, minus 12. So you must really be very keen here. See where your fair value is. Fair value is the same as market value. When market value is higher than the book value is the same as carrying value, then that is a revaluation up. Revaluation up is an increase in the value of the assets. So go and increase. Now, once you have this revaluation upward, or rather revaluation, we must always think of depreciation on revaluation. Depreciation on revaluation. My I can see a very good question there. Depreciation on revaluation. Sorry, just 1 minute. 1 minute, just a minute, just a minute. Great. So, ladies and gentlemen, from there, I would want somebody to help me now calculate this depreciation, depreciation on revaluation, depreciation on revaluation. This is not an easy one, but of course, with my explanation, you'll be able to understand. So depreciation on revaluation. This is very easy, because what I'll do is to take the revalued amount or revaluation, you divide by rule. You divide by rule, where rule is the remaining useful life. Rule is the remaining, think sun, S-U-N. So you take the revaluation over the remaining useful life. So revaluation, ladies and gentlemen, what do we have for revaluation? You have given me 12. And what is the remaining useful life? Let's read together this. Remaining useful life. So the remaining useful life, ladies and gentlemen, that I have here if we read this together, we are saying here, on 1st January 2017, Hadi owned some item of equipment with a book value of 45 million that had a fair value of 57 million. These assets were originally purchased by Hadi on 1st January 2015 and are being depreciated over 6 years. Remember, 6 years, these are what years? So we have two dates here actually. We have in this case the very original date when we purchased this. It was 1st January 2015. And then we did a revaluation on 1st January 2017. All right. All right. So, ladies and gentlemen, please listen and listen to me very well. Please listen and listen to me very well. This is very interesting and it confuses students. It has never confused me. It can never confuse me. I'm never confused with easy things. Never. So you see, this asset here, they have how many years? 6 years. The useful life is 6 years. By the time we are revaluing them, how many years have passed? So it is 2015 because we started from 1st January. It is 2015, the whole of it. And what year somebody? 2016, the whole of it. Don't count 2017 because 2017 is at the very beginning. So by the time we are revaluing this thing, we have already consumed 2 years. 2 years. So then what is the remaining useful life? What is the remaining use? Because already we have extinguished 2 years. So the remaining useful life is 4. The remaining useful life there is 4. The remaining useful life is 4. And then, ladies and gentlemen, remember, after that, we want what we call cumulative depreciation. So we must come here and multiply this with what we call the DOF minus the DOA. The DOF minus the DOA. We must get the time period here. DOF, for the students that I've never taught before, DOF stands for the date of the financial statements. Date of financial statements. DOA stands for date of acquisition. Date when we acquire the subsidiary. So, because I want, you know, this 12/4 will give me 3. I'm depreciating 3 for each year. 3 for each year. But you know, they want cumulative here. They want cumulative. So I want to know how many years that I stayed with this subsidiary. So in this question, we know that the date of acquisition is 1st of January 2017. This is the acquisition date. How about the date of the financial statements? How about the date of the financial statements? How about the date of the financial statements? So the date of the financial statements, ladies and gentlemen, we are given here, the statements of financial position for the 3 companies is 31st December 2019, 31st December 2019, 31st December 2019, 31st December 2019. So remember, this is the DORA and this is the DOF. DOA and DOF. So could you kindly count and tell me the number of years that we have in, or the number of months? I want years really. I don't trust any lady with counting time. They never get it right. I don't know why. They never get it right. You'll see even here. They don't get, no lady can ever get this right. Let's see. Men, I know men will get this very correctly, very fast. But ladies, like Indego has gotten, yes. It is 3 years, you're right. So in this case, you count the whole of 2017, the whole of 2018, then we have the whole of 2019, because 2019 we are going to the end. So basically, the total depreciation will be 12/4 is 3 times how many years have you gotten here? How many years have you gotten there? 3. So therefore, the total cumulative depreciation is 9 minus 9, like that. Great. Great. They are saying repeat. Now, the first thing is for you to appreciate here this thing. The revalued amount, of course, is 12 over the remaining useful life. Remaining useful life. From the date of revaluation, moving forward, how many years do you have? How many years do you have? So, ladies and gentlemen, can even come here. I'm so sure this is something, if you take your time a little bit, maybe later on, I'm so sure with the video, it is something that you guys will be able to understand. It's not really a big thing, because when we talk of remaining useful life, this asset, when we bought it, it had 6 years, and we bought it here, 6 years. And we came and did the revaluation on 1st January 2017, when we were doing the acquisition of the subsidiary. That's when we acquired the subsidiary. And that's when we did revaluation. So then between here and here, how many years do we have? We have, in this case, ladies and gentlemen, the whole of 2015, the whole of 2016. Don't count 2017 because it's the beginning. So by the time we are doing revaluation, already 2 years have lapsed. So then the remaining useful life will be 4 years, because it is 2 gone out of the 6. So now remaining useful life is 4 years. That's how I got this for 12 over 4. But you see, 12 over 4 is 3 per annum. And ourselves, ladies and gentlemen, we want to get cumulative depreciation to date, to the time we are doing the financial statements. And how do we get this cumulative period? You take the time of the financial statements, the date indicated there, minus the date of acquisition. The date of the financial statements is this, 2019. And the date of acquisition is 2017. If you count in between here, you are getting how many years? 3 years. You're getting 3 years. This confuses students. I would want you to go and rewatch this video, not once, not twice, until you master. It's just one logic. You master this. You master this. What about? Thanks, Purity. Okay, let me understand. Great. Thank you very much. Now, a good question there, that DOF minus DOA is 3 years, but it is from first 2015 to this, that is 4 years. Let's see, let's count. I can 100% guess that that is a lady. That's a lady. Anyway, look at this. Let's count together. So we have here, let's count together. Sikubaya, ni jokes tunasema sikubaya. Jokes tunasema. There is a time I told my girls, of course, all of you here are my girls, my daughters here. So I told them that ladies do not know how to count dates. And then now most of them told me, Mwalimu, did you try that? And you got a baby? No, it's not about that really. It's not about that really. Great. Let's count this. You see, the date of acquisition, my friend. Laurel acquired this on 1st January 2017, not 2015. 2015 is when the assets were being acquired. Here we are talking about acquisition of the subsidiary. This subsidiary acquired it in 1st January 2017. And the date of the financial statements is 31st December 20. So count from 2017. So it's 2017, the whole of 2017, 2018, and then we have 2019. I'm getting 3 years. Can you kindly confirm that now you have understood? Before I continue, please confirm that you have understood. Please confirm. I get it now. It's acquisition of subsidiary, not asset. So then are we together now, all of us up to here? Of course, it cannot be really easy to explain 100%, but I believe with the video being given to you later on, you'll be able to see this concept of depreciation. It really confuses so many people. What if they gave us information about comic? Because that is how they normally like confusing you. Comic, about comic. In this case here, for example, revalued assets, comic. Do you start the workings of comic at this stage? Not unless you're another one. Comic is an associate. We don't bring associate metrics here, parameters here. So then allow me to go to the next sentence, note number 3. Note number 3, they're telling me Group policy is to measure NCI. I'll be doing this later. Cumulative impairment losses on recognized goodwill amounted to that. I'll also be capturing this later. Now, ladies and gentlemen, it is after I've done this that I will now start my other workings. After I've done this, don't do anything yet. But after I've reached here, now I can go ahead and do the other workings. Who can talk to me tonight? Look at me straight away on my face. Address me, but don't call me honorable. Address me live and tell me, what do you think will be the most important working now, from now moving forward? What do you think will be the most important working that I need? Without that working, I cannot make another move. Goodwill, thanks for trying, but no. Owings, no. NCI, no. Net assets of the subsidiary. Net assets of the subsidiary. Who is this who answered that question? I need to give that guy a present. Who was the first guy to get these net assets of a subsidiary? Net assets. No, what is the name of this guy? It's Elizabeth. Wow. Elizabeth, can you kindly put your number there during our, let me send Elizabeth something. Let me send Elizabeth. This is impressive. I mean, those are the students now. So net assets. So now we're looking for net assets. Even if you understand nothing about this, just go ahead and scare the examiner. Write this in capital letters. Scare this examiner. Scare this examiner. Scare this examiner. Write in capital letters. How I wish my board was big enough. Net assets of the subsidiary. So in this case here, I have the net assets at the date of acquisition, and net assets at the date of financial statements. So is there somebody who is able to remind us? Is there anybody who is able to remind us, ladies and gentlemen? Is there anybody who is able to remind us, ladies and gentlemen, the equity components? Remember, we're talking of equity components. What should I write here, somebody? What should I write here in this table? This important table. Ordinary share capital. Thank you very much. Ordinary share capital. We have share premium, share premium, share premium. We have retained earnings, retained earnings. We have retained earnings, retained earnings. We have revaluation, but we call it fair value. Here, if you want to scare the examiner, you call it here fair value adjustment. That's how you call it here. Fair value adjustment. You call it fair value adjustment. And then lastly, depreciation on fair value. I think I need to give somebody a present. Depreciation on fair value, depreciation on fair value adjustment. And then there is this student who does not want me to know their name. This student in this case here who is using SIP. This is a very bright student. She has known something that most of us would not have known. She has known that if we have UPS, remember we have got UPS upstream, UPS downstream. Which UPS do we normally bring here? Which UPS do we normally bring here? Is it UPS upstream or UPS downstream? It is UPS upstream. UPS upstream. If it's UPS downstream, you don't bring it here. If you have UPS upstream, you bring it here. So somebody who has never done this class with me before, remember upstream means where the subsidiary sells to the parent. So it's up. Sales is from subsidiary to the parent. Parent is bigger, is up there, up there. So whenever sales is done by the subsidiary to the parent, then you bring UPS here. That's called UPS upstream. UPS upstream. And realized profit, yes. Ladies and gentlemen, please, in this question, could you kindly tell me what kind of UPS do we have? Of course, we have UPS. Is it downstream or upstream? Let me see. What kind of UPS do we have? Remember, Laurel is our parent. Laurel is our parent. Laurel is our parent. Laurel is the one that sold to the subsidiary. They're not talking to me. I don't know why. Is this upward or downward? This is downstream. Thank you so much. This downstream, this downstream, this downstream. So if it's downstream, then what we do, because we don't have upstream, here we shall have dash, dash like that. Dash, dash. Thank you very much. UPFA is unrealized profit on fixed asset. Here we never had any fixed asset transfers between the two related entities. So we don't have UPFA here. Thank you very much, AFO, for clarifying that. I like that. Thank you so much. Now, ladies and gentlemen, from there, then I would want us to come here and get. No, don't be sorry. Never be sorry. Never be sorry. Just be a nice girl. Ordinary share capital. So what ordinary share capital amount should I bring here? I'm lost for, spoiled for choice. Do I take 400, 96, or 80? Remember, these are net assets of the subsidiary. And the subsidiary is the one that we have here called Hardy, which is 96. Saturn should not pay us a visit here, because we'll get somebody taking 400. No. It is 96, 96. So for the DOA, date of acquisition, we have 96 and here 96. How about share premium? How about share premium? Share premium, again, we are taking the share premium of the subsidiary. Share premium of the subsidiary. So the subsidiary share premium, ladies and gentlemen, share premium, ladies and gentlemen, here for the subsidiary. We have here share premium for the subsidiary is 3. So 3. Shetani akiguza unasema 30. Oi, atuguzi kitu ya comic. And that is why if it's an exam, I'll always cover this comic. If I'm using Excel, I'll come and in this case here, just highlight this and do it like yellow. I love yellow color. Yellow is the color of the country. So 3. So come to the retained earnings. Retained earnings, you have to be very careful. Retained earnings, you must be very careful. Retained earnings, you must be very careful because here we expect things to change. So retained earnings, like this retained earnings that we have here of 128, where should I write this retained earnings of 128? Is it at acquisition or at financial reporting? I've read that figure from the financial statements, financial reporting, financial reports. So we have 128. And then retained earnings at acquisition in most cases will be given to you. This will be given to you. In most cases, these will be given to you. In most cases, this will be given to you. So like now here they have told us, Laurel acquired 80% of the ordinary share capital of Hardy for 160 million and 40% of the ordinary share capital of Comic for 70 million on 1st January 2017, when the retained earning balances was 64 for Hardy. 64 for Hardy. In this case here, 24 in Comic, that's very nice. But anything as we start our group consolidations, anything to do with an associate is hot air, is useless. So the only thing that you want now is what year is 64. Retained earnings of what year of the subsidiary at acquisition, 64. Now, is there anybody who is able to remember our evaluation amount? Is there anybody who is able to remember our evaluation amount? 12, right? So it is 12 there, 12 there. Remember, evaluation amount is the same. How about depreciation on fair value adjustment? This is dash. I'll put something here. Is there anybody who is able to remember? The total depreciation. Thank you so much. 9. Great. So then come and give us the total net assets. Give us the total net assets. At acquisition, is there somebody who has the total here? At acquisition, is there somebody who has the total here? 175. Who is telling me the truth now? I don't know. Somebody is saying 173, another one is saying 175. How about UPS? So remember what we said about UPS. If it is UPS, here we have a downstream UPS, it doesn't affect us at all. If it was upstream, where the subsidiary sells to the parent, then I would have brought the figures here. So 175. So this is 175. How about this one here? DOF. DOF, is there somebody who can get a DOF? DOF, I'm being told, is 230. 230. Again, remember that this depreciation you subtract. Depreciation we subtract. Nancy, depreciation we subtract. Depreciation we subtract always. Depreciation we always subtract. So you subtract, what are we getting? Somebody there? Somebody. When you subtract, it's 230, isn't it? Depreciation you subtract 230. And then now the difference between these two, numbers, those two numbers, normally we give it a special name, PAP. So PAP stands for post-acquisition profit. PAP stands for post-acquisition profit. So 10 is giving us 220. I don't know how they're getting 228 really. So PAP, I'm being told that PAP is 230 minus 175, which is 55. PAP is 55. PAP is 55. So please don't forget that depreciation is normally subtracted. I know that is where the difference is coming in. Depreciation is supposed to be subtracted. Now, once we get this post-acquisition profit, what do we do with it? 64. Retained earnings. 64 is retained earnings. 64 is retained earnings at acquisition. 64 here. Retained earnings at here. Retained earnings at acquisition when we are acquiring this subsidiary. I hope that is helpful. So we allocate this, isn't it? So we share. So you give us out of this, give us the parent share. The parent share. So the parent share, remember the parent has got what percentage? The parent has got what percentage? The parent has got what? 80%. 80% of 55. 80% of 55, that gives me 80% of 55. That gives me 44, isn't it? That gives me 44. Thank you so much. From there, of course, because the parent has got 80%, there must be another stakeholder who has the other percentage. What is the name of the other guy? The other guy. It's NCI. NCI. So you talk of NCI's share. NCI's share, it is 20% of 55, which will give me what there? 11. Which will give me 11, isn't it? Which will give me 11. Which will give me 11. 11. Thank you so much. Thank you so much. Now, ladies and gentlemen, up to here, I'm so happy. But now, I would want somebody to talk to me again tonight. Macho kwa macho. I would want somebody to tell me, what do you think will be the next working for us in this case? After getting net assets of the subsidiary, I'll be able to get the PAP Goodwill. I'll not go for Goodwill that fast. I will go for NCI. It's easy. NCI. I'll go for NCI. It's very easy. NCI is very easy. So I'll come and give them NCI at reporting. I'll give them what we call NCI at reporting. Let me pause a little bit and ask students who are writing this in Excel, are we together up to here? If you're writing in Excel, or am I too fast? It's very good for you to give me the honest opinion. Are we together up to here? Great. Great. Thank you so much. Thank you so much. Thank you so much. Very together. Thank you so much. So then NCI at reporting, this will be equal to NCI at acquisition. NCI at acquisition, is there somebody who is able to see NCI at acquisition? Is there anybody who is able to see NCI at acquisition? NCI at acquisition, yes, they have told us. The group policy is to measure non-controlling interest at acquisition at fair value. The fair value of NCI in Hardy on this is 39 million. So this is 39. So NCI at acquisition. So NCI at acquisition is 39. And then, of course, we expect these guys here stomach to become bigger and bigger as a result of what here? What will decrease this NCI's value? What will increase this NCI's value? The PAP, isn't it? So in this case here, PAP. So we have here PAP. So share of PAP. Share of PAP. Share of PAP So share of PAP, you guys give me a figure. I've forgotten the figure. Mulipata ngapi? 11. Of course, ladies and gentlemen, life cannot be that nice all through. As you are getting, in this case here, bigger tummy, there must be other things that we are nakotoboa. So in this case here, what do you think will be making these guys here lose? What do you think will be making these guys in this case here to suffer some losses? Impairment loss. Who is this? This is Ruth Mora. Have I ever given Ruth a present? I don't think so. You must be a very bright student. You must be a very bright student. So in this case here, come under less share of impairment loss. Less share of impairment loss. So remember, these guys' percentage is 20%. Unfortunately, we are given the impairment loss. We are told here, cumulative impairment losses on recognized goodwill amounted to 15. So out of this 15, NCI must also suffer. You know, it's a partnership. When we make losses, we share with them. When we make profits, the PAP, we share with them. So now we have made losses in goodwill, which was impaired, 15. We have to share this loss with them. So what is 20% of 15? 20% of 15, somebody is telling me it is 3, like that. So then what is NCI at reporting? NCI at reporting. NCI at reporting. NCI at reporting. Somebody is telling me 47. Somebody is telling me 47. Somebody is telling me 47. So please come here where you are seeing NCI, write 47 at the very corner. NCI, write 47. NCI, write 47. And by the way, at the back of that book, we have answers. At the back of that book, we have answers. I would want someone to take note of those answers. Please go back to where that answer is and try to see whether we are right. 3 imetoka wapi? 39. Is it a 9 Imelda? Or 3? Oh, okay, 39. I understand now your question. It is NCI at acquisition. You can see this. NCI at acquisition is 39. Thank you so much. Now from there, we go to goodwill. Let's go to goodwill. Let's go to goodwill. So let's go to goodwill. So up to here, are we together? Can I wrap this section? Can I wrap this section? Can I wrap this section? Thank you. So goodwill, because I'm seeing in the question they have given me NCI information, I'm going to use full goodwill method. Full goodwill method. So in this case here, I will come and mention here goodwill. Very easy. I look at the parent's consideration. The parent's consideration. Then I have the NCI's consideration. NCI consideration is the same as fair value of NCI at acquisition. This question that this young girl was asking there, which is 39. Do you remember that figure of 39? Do you remember that figure of 39, somebody? Do you remember that figure of 39? I think I'm alone now. 39, which was the fair value of NCI at acquisition. And then we'll come under less, net assets, with less net assets at acquisition. Is there anybody who is able to remember the net assets at DOA? Net assets at DOA. Net assets at DOA. Net assets at DOA. Net assets at DOA. So net assets at DOA, I'm being given a figure of once, they're here. Net assets at DOA, 175. So then the only thing I need, it will be the parent's consideration. So parent consideration, how much do the parent pay for their stake? For their stake. Parent's consideration, 160, right? Parent's consideration, I'm being told, ladies and gentlemen here, the parent's consideration, I'm told dear Laurel acquired 80% of the ordinary share capital of Hadi for 160 million. 160, you're right, thank you. 160. So 160. 160. So could you then kindly give me the goodwill at acquisition here? Give me the goodwill at acquisition. Give me the goodwill at acquisition. Will you subtract now? Goodwill at acquisition. I'm being given a figure of 24. So when I get this goodwill at acquisition, it's an asset, just like any other asset. It's subject to depreciation. Although being an intangible asset, we can't call that loss in value depreciation. We shall call it impairment. We shall call it impairment. We shall call this impairment. So less impairment loss. Is there anybody who is able to remember what the impairment loss is? Is there anybody who is able to remember the impairment loss? 15, right? So in this case here, 15. So could you then kindly subtract here? Kindly subtract 24 minus 15 gives me what figure? Gives me 9. So then this is the goodwill at the end of the year. So we call this one goodwill at reporting. So at reporting, this goodwill here is what will come and write at the very corner there, 9. The goodwill there is what will come and call 9. So up to there, first of all, are we together really? Is there anybody who has been able to follow up to there? Anybody who has been able to follow up to there? Great. And you really have the answers. If you go to this particular book, Laurel, let me just say control find. So you can see like goodwill, if you're able to see my book here, goodwill, they are getting 9. If you look at, for example, non-controlling interest, if you remember, they are getting 47. Quite interesting. The only thing that they do, they use a very bad method. They use a very old method. They use a very old method to do these workings here. We need to be direct. Fortunately for me, I'm very lucky. You know, I work for a company which provides a group consolidation software. We have given our software to Equity Bank, EABL, and many other companies, right? And of course, it's a global company like Sony. They are consolidating using our software, right? And I'm the one who is in charge of what here training in this Swedish company. So these are things I train every day. So whatever I'm teaching you here is very applicable in real life. These are how we do it. These are how we do it every day. And we do a lot of consultancy, even yourselves. If you have got any questions of on consolidation, I can see there are so many questions. How comes NCI yangu ni 35? NCI. Let me go back a little bit. Is it your network which is disturbing or something? I don't know. Because you see, like NCI, we said NCI at the beginning. I'm sorry, I rubbed my working here. NCI at the beginning, NCI was 39. And then we gave them some profits. Do you remember the profits we gave these guys? What was the PAP which was given to NCI? Can somebody give me the PAP given to NCI? 11, isn't it? So you take 39 plus 11, and then you subtract share of what year? The impairment loss. Remember, impairment loss was 15. So these guys, you give them what year? 20%, 3. So if you take that 40 minus 3, that's how we got, is it 50? 50 minus 3. So we got 47 for NCI. Now, some questions students are asking here, students are getting confused a little bit in terms of goodwill here. Goodwill, remember if it's goodwill and you're using full method, you can't apportion impairment loss. Full method, you have both NCI and parent here, so you're taking impairment loss 100%. We only get to apportion this impairment loss if you're working on, or rather with, partial method. Partial method, if you're working with partial method. So first of all, are we together up to there then? The student was asking about 1512. Here we shall work with 100% because this is full method. This full method. All right. Somebody is again telling me to repeat on this goodwill. What we have done, we've taken the parent's consideration. The parent, to get 80% of the shareholding in this subsidiary, they paid 160. The NCI, during this acquisition, the NCI's value was 39. NCI's value was 39. And then we come and subtract, you less the fair value of the NCI at, you less net assets at acquisition. This net assets here at acquisition, which was 175. So once you subtract like that, you'll be able to get goodwill at acquisition of 24. And then you less, in this case here, the entire what here? The entire impairment loss. I know what is disturbing you a little bit is that apportionment, the 3 and the 12. That 12 will come later when I'll be doing the parents' retained earnings. The parents' retained earnings here. I'll be booking the 12 later, but for goodwill computation, if it's full method, good questions here. I'm getting very good questions here. How did we get 3 as the difference between DOA and DOF under depreciation? So, gentlemen, with the remaining 10 minutes, I don't think we can do quite a lot. What I'll do, this particular video, I'm going to hang it on YouTube. All right. And of course, I'll share the link with you. And of course, when you reach there, you need to promote your teacher. This is an international teacher. Take this teacher high up there. Let this be an upward stream transaction. Lift the parent up. Lift the parent up on your parent by sharing those videos. And of course, bringing students to this particular kind of discussions. These are the best discussions. So remember, it will be very important for you to know that for your exams, you must understand cash flow statements very well. You must understand group accounting very well. Right? So, of course, after the associate, I'll be able to also handle the joint ventures, etc. So I'll be able to, actually, if I were you, for the sake of, although, let's discuss this in our various WhatsApp groups. So it's my hope that you have enjoyed somehow. Of course, I can see most of you still have a lot of questions, but somehow, at least this thing now is making some sense. It's making some sense. That's my hope. That's my hope that now it's making some sense. International it is. International it is, yes. Lazima muinuke, we shall overcome. What is your channel's name? Joshua Aura. Just look for Joshua Aura. You'll be able to get me there. Joshua Aura. Yes. Great. From Southern Sudan, Joseph Thorn. Thank you very much. Thank you very much. Great, great. From Dar, you can see HP already. From Dar es Salaam. Great. Yep. We haven't done investment in associate because I would need like an hour, all right, to just concentrate.